Okay, so squeezing the juice out of your UL contracts. There are pretty much three different ways that we have to try to extract extra value and help you guys price your cases or get bigger offers for your clients. The first one's really simple. There is a minimum guarantee premium that a lot of these contracts have. Sometimes they're 5 years, sometimes they're 10 years. These things are only helpful when you have a client with a life expectancy range that are within those timeframes. So if you reduce premium significantly for a certain period of time, and then you got to pay all the catch-up premium to pay back, and it becomes way more because you're grossly underfunded, well, then it's problematic. But if you have a minimum guarantee, check that provision. It's a one little line. Then that can often reduce costs significantly, makes a bigger offer. The other, excuse me, the other kind of trick that you have is sometimes you have policies that were really overfunded and they may be carrying a lot of cash, and you're at a point where you can reduce premiums to a certain amount, but there's still extra buildup in there. Because Magna is owned by a investor, we're a buy and hold predominantly shop. So what that's going to mean is once we take ownership, you'll be able to, or we can take a loan from the policy and have kind of an arbitrage play there, which can often drive a % or two more on our IRR. And the higher we can push the IRR for the investor, the more aggressive that we can be in making an offer. So I would say if you have a policy with a lot of cash, you always want to submit a copy of the policy in the most recent annual statement on top of the typical normal in-force illustration that we want run minimum level to maturity with 1,000 in cash ran on the non-guaranteed side. So add that extra stuff if you have a lot of cash, because we'll be able to optimize a loan. So I'm kind of saving the best thing for last. There is something that we call NLG pricing, and that's going to be on your contracts, UL contracts that have secondary guarantees. Now, some contracts are more complex than others. They may have 2 or even 3 different shadow accounts. These are accounts that hold cash value that doesn't show up on your, excuse me, that doesn't show up on your client statement. So if you can provide a copy of the policy, a premium history of every premium that was paid, how much and when, and an annual statement, we're going to read through the policy, identify all the different sub-accounts. We're going to overlay the premium history into those accounts. So we're kind of reverse engineering the product. And then we're going to use the annual statement and your in-force to kind of back check our math and make sure we're good. Now, this can be very, very significant on the premium load. And I'm going to share like a case example that we did this week. 85-year-old male. He was issued standard non-tobacco with Transamerica Trans-Ace GL issued in 2004. So Trans-Ace GL issued in 2004. Now, this particular gentleman had a life expectancy of about 6 years. And when we were pricing it based off the conventional minimum COI illustration that we had, we were able to offer about 240,000 on this. After doing the NLG pricing, had those additional docs come in, we were able to go from 240 to 490,000, as well as pay 20% less in premium load for the life of the contract of what we expected to pay. This also delayed us paying premiums for almost 50 months. So the majority of the file, we didn't have to pay out in the beginning, and we were piling it on in the end. So, you know, that is a tremendous, tremendous difference. Now, in this particular contract, it was overfunded in the beginning. which really juiced up all of those sub accounts and had a ton of extra value, which you would never get to see in the policy. So once again, I know I kind of gave you a very specific example of a Transamerica case, but this is all NLG products. So it really kind of comes down to how were they funded along the way. So maybe you don't get as much juice, or if they were ever overfunded, then you could get a tremendous difference, like in this case example.